Everyone, and welcome back to another episode of the Optimized Wealth podcast. My name is Lance Norquest, investment advisor with Bellwether Wealth, joined by economist Alan Beaulieu. And today we're focusing on how investors should think through the current environment without reacting emotionally. Now, Alan, I'm sure that you've read a number of headlines, news articles in recent months, and we've seen a lot of items that spark fear or imply maybe the economy is on the brink of collapse and maybe it's going to drag markets down to a crash as well. So maybe to start things off, what do you think our listeners should consider when maybe reading the latest news and headlines? It all comes down to the underlying data and probably separating the information from the narrative, right?
You're right. And we certainly like information. You and I are both driven by information as opposed to just a headline. And I noticed, for instance, today, when the other day and today, oil prices come down a little bit, but the headlines will say they plunge. But it's not a plunge. I know what a plunge is. And so we're getting a lot of that. So you and I like leading indicators, and there's some good ones out there, but they also conflict. Like the ISM right now is showing good things in the service and manufacturing industry, and the OECD leading confidence index is declining for the last 2 months. One that I was talking to you about was the small business confidence index, but out by the Chamber of Commerce and MetLife. And just a couple of facts on that one, if I could, because I thought they were interesting. 53% of small business owners said inflation was their top challenge. And they're right. That is their top challenge. And for investors, that's a top challenge too, because we're going to discuss in a second, it's not going away. Another fact from the survey was that only 37% said they'd make new investments in the year ahead. That's a big deal. Only 37% making investments. That has to do with the capital good expenditures and buildings and all the rest of that. So that's significant to the economy. The most stunning fact was 28% said the U.S. economy is in good health. So, 72% were not in good health. That really impacts people thinking and tells us a lot because these are businesses up to 500 million, 500 people and 500, I forget how many millions, 50 million, $100 million in revenue, something like that. So we're not talking the guy that's repairing lawnmowers, ducking businesses that make decisions. And at the same time, my mind is I got to talk to Lance because the stock market had today, as we're recording this, record highs. This is phenomenal, right? I feel like I'm dealing with Eeyore and Tigger at the same time. It wasn't much of an economy. It'll all be fine. So let's talk longer term. All right. And you're going to help us with the emotional part in just a moment. And while I'm still at it, the longer term, our listeners should expect inflation will stay with us. Right now, the PCE, personal consumption expenditure, that the Fed looks at is at 3%. That's pretty high. And even if the thing in the Gulf gets squared away, it takes a while for aluminum prices to come down, fertilizer to start being made. Food prices are going to stay high for a while. Labor is going to stay high because while we have less hiring going on, the labor participation rate's coming down and more boomers are leaving the market. So that still leaves a shortage. So in the midst of all that, inflation is going to be with us because of oil, because of labor, probably see some higher taxes as we go forward. More unsettling news will be coming our way. It could be rare earth. It could be another blow up in some other part of the world. There's always something coming that's going to cause some sort of supply chain concern or shortage of this. As a matter of fact, the president's tariffs are coming back probably in July. The Supreme Court struck him down. He's figured out a new code to work around them. So that's more inflationary pressure. So I can't help but see inflation in our future. So help us all, Lance, with your wisdom. We got to deal with the emotion and we have to deal with inflation. I'm listening. I'm going to take notes too.
Yeah, let's start with the emotional piece. So obviously there's conflicting data, as you mentioned. Some things are looking great, some things not so great. At the end of the day, as we started things off, when you're reading into these headlines or whatever news piece you're following, you always want to make sure you're separating the information from the narrative because those headlines, they're really optimized to get your attention, and you really shouldn't use those to make decisions. And if you find that you're doing that, I would encourage you to maybe hit pause and just ask yourself, based on what you just read, or based on maybe what you've been reading over the last several months, have your long-term goals actually changed because of any of this? And the answer is likely no. Or if they have, it was probably a part of the plan to change things anyway, such as if you were coming up on retirement, for example. Another thing you could ask yourself is, are you reacting to the fundamental data changes, or are you simply reacting to price movements and change in sentiment? Now, in some cases, some of that information is important, but again, if we're looking at it over a short-term piece here, you want to make sure you're not allowing emotions to take over. And as humans, we all have emotions and we all have what we call behavioral biases. And a couple of behavioral biases that we've seen recently due to the Middle East conflict and just a lot of inflation and all the things that you just mentioned, Alan. One of those being recency bias, which is essentially you're looking at recent market returns, recent headlines, and you're allowing it to, or you're using it to make important decisions rather than performing a thorough analysis, if you will, or following your long-term plan. Now, instead of allowing behavioral biases or emotions to take over decision making, what you should actually do is number one, the easiest, just stay invested according to your long-term plan. And that's going to help with the recency bias without using short-term pieces of information
Sure.
to make long-term decisions.
Makes a lot of sense. Makes a lot of sense. Do you have anything specifically that can light up the path when it comes to this 5 years, at this point it's 2026, so 4 years of inflation that's ahead of us? Not the kind that lights the world up like the early 1980s, but just that nagging, would this please stop kind of inflation.
Yeah, so if we start to really transition and the data really transitions into a higher inflationary environment, there are certain areas of the economy that you could maybe diversify your portfolio towards and other areas to get away from to structure for that type of an economic environment. And a couple places to look at maybe putting money or potentially getting your investments into would be like consumer staples. So think personal care products, groceries, beverages, and healthcare. These sectors, they typically have strong pricing power, which essentially gives them the ability to raise prices without losing customers. And it also allows them to maintain some of those margins because when inflationary pressures are high, usually margins get squeezed. But again, that pricing power gives them an advantage here. A couple other sectors that could fare well in a higher inflationary environment are energy and materials. These particular sectors, they're closely tied to the commodities markets, which is considered a hedge during high inflationary environments. But by investing in the actual companies, you're getting the equity upside by owning those companies directly tied to the commodities instead of actually buying the commodities themselves and having potential for more volatility in that particular
Mhm.
market. And some
Sorry.
places to maybe avoid. No, you're fine. Places to avoid. Again, when we're in a high inflationary environment, you want to avoid things that are called long duration assets, or maybe try to diversify away from it somewhat. And one example of a long duration asset is a growth stocks. So growth stocks derive their value or their returns based on the present value calculation of future cash flows. Sum that or dumb that down. Basically, you're using interest rates to calculate that present value of the future cash flow. And when interest rates rise in a typically a higher inflationary environment, you're it's discounting those cash flows more heavily, and it's impacting their valuations and the returns that you would see in growth stocks. Another place you may also want to avoid or again diversify away from in your portfolio are long-term bonds. Again, high inflation usually translates to higher interest rates, and bonds have an inverse relationship to interest rates. So when interest rates are rising, the market value of bonds falls. Think 2022, for example. And the length or term of your bond or the duration of your bond it magnifies that change in interest rates, or it magnifies the market value change due to the change in interest rates. So by having a long duration or long-term bonds, it's going to be hurt that much more than maybe a shorter duration piece. So something to avoid there. Everyone's situation is different, and that's why we tailor the recommendations and advice that we provide to each individual client based on their needs.
Excellent. I like the plan. We live in choppy waters, but at least you got the sail set and we're heading in the right direction. So that's good.
Exactly. Yeah.
And by the
Any
way, not
closing?
everybody has a heart. I'm an economist. I don't have a heart. I'm the first living heart donor. So just
Oh, you have a heart. For
tell
our
me.
listeners, for anyone that is interested in learning more about how to apply these different types of strategies in your portfolio or how to diversify away from certain impacts due to economic conditions or inflation, for example, feel free to call our office at 402-476-8844, or you can also reach out to us using our chat feature on our website at bellwetherwealth.com. That's all for today's episode. Again, thanks for joining us. I'm Lance Norquest with Alan Beaulieu, and we'll see you next time on the Optimized Wealth Podcast.